Our guest today is Nathan Holmes. He's a partner of Thompson, Hine in Dayton, Ohio. This is all part of our Doing Deals Hot Takes conference. This one is about golden parachute disclosures, hot takes. I'm Brock Romanek, today on Zippy Point. So Nathan, golden parachute disclosures for deals. How do golden parachute comp disclosures differ from the change of control and termination disclosures that are otherwise required in the proxy?
Thanks, Brock. There are some real differences. The disclosure rules under item 402J of Regulation SK for your annual proxy statement are pretty well known, right? You work with those every year. They require you to disclose and describe and quantify the compensation that would be paid to your named executive officers in the event of a change of control or any other sort of termination scenario, making the assumption that that triggering event occurred on the last day of the year. Now, the way those tend to be described usually includes a table of some sort, or maybe multiple tables that show in these various scenarios what your named executive officers could be paid if one of these events occurs, including a change of control. But the SEC rules actually build in some flexibility for companies. They tell you what you need to disclose, give you some information about, assumptions you need to make, but they don't really tell you the format. So you can kind of develop a format for meeting that disclosure requirement in your annual proxy statement that suits the company's compensation program. In contrast, golden parachute disclosures for deals under item 402T of Regulation SK, the SEC's rules really prescribe a particular format for how your disclosure is going to be made. There's a special table, they're called the golden parachute compensation table, that's got a particular format with certain columns that are prescribed, and that's what you're supposed to disclose. Include that table and include a narrative description that gives readers the information they need to understand the numbers that are disclosed in the table. So that disclosure differs in a number of ways from the regular annual disclosures. One example is, it's a prescribed table. There's a format that the SEC requires you to use, which chances are it's not exactly identical to the one that you're using when you describe the change of control payments in your annual compensation proxy statement. Also, obviously, the change of control deal disclosure table is really focused on a change of control. The other scenarios that you talk about in your annual proxy statement, retirement, death, disability, they aren't relevant here. Here you're focused on disclosing the compensation payable to the NEOs in the event of the particular change of control transaction, whether that's single trigger compensation or double trigger.
So we have say on pay for regular annual shareholders meetings, but when there's a deal that's happening that requires shareholder approval, there's also say on golden parachute disclosure too, right?
That's right. If you've got a transaction where shareholders are being asked to vote to approve a merger or acquisition, sale, or other disposition of substantially all the assets of an issuer, then you're going to need to generally include this golden parachute compensation disclosure, and the shareholders of the target company are going to get that non-binding advisory vote, the say on parachute vote in this case, to approve the compensation payable to the NEOs as it's disclosed in the parachute compensation table and the accompanying narrative description. One thing that's interesting is there's actually a little bit of a difference between the standards for when do you have to include the golden parachute compensation table in the proxy statement, and when do shareholders get that say on parachute non-binding advisory vote. I mean, in most cases, you're going to include both, right? Shareholders of the company that's being acquired, they're going to be given the opportunity to vote on the transaction, and if they do, the target company is going to include the golden parachute table and give their shareholders the opportunity to vote. But there's also some different situations, and I've seen this happen where you might be required to include the golden parachute table in a proxy statement, but not give shareholders the non-binding advisory vote. The situation I've seen is let's say the acquiring company is going to give its shareholders a vote to approve the authorization of additional shares. They're going to be used as consideration in the transaction. So shareholders of the acquirer, in addition to the shareholders of the target, get to vote on authorizing those additional shares, but the acquiring corporation shareholders are not actually voting on the transaction itself. In that scenario, I think what you'll find is you have to include the golden parachute compensation table in the proxy statement for the acquiring corporation. Might not be a lot to disclose, but you got to include the table. But you probably don't need to include a non-binding say on parachute advisory vote for the acquirer shareholders in that situation. Just an interesting discrepancy that comes up not frequently, but from time to time.
Yeah, it can really trip you up. So let's talk about named executive officers. That's a defined term in the SEC's regulation. How does that come into play with this golden parachute table?
Sure. I mean, obviously, a deal could come up at any time, right? And if you had to, redetermine who your named executive officers are in connection with the transaction, that could add a bit of a complication to what's already obviously a very complicated process. But luckily, the SEC rules basically say you can look back to the most recently filed summary compensation table and include those individuals. Now, obviously, if you've got a new CEO or CFO, those folks are named executive officers by category, right, by virtue of their title. So you're going to have to disclose those folks in the golden parachute compensation table. But for identifying the three most highly compensated executive officers other than the CEO and CFO, you get to look back to your last proxy statement or 10K registration statement, whatever the most recent filing was that you made that included a summary compensation table.
And then tax gross ups, those have been disfavored now for a number of years, both by shareholders and the proxy advisors. But how did the disclosure rules address them for this table?
Yeah, that's right. Obviously the old-fashioned tax gross up provision for excise taxes triggered by a deal, the golden parachute gross up, that's pretty much gone by the wayside, and you rarely, if ever, see those anymore in the wild, right? But the golden parachute compensation table that the SEC has prescribed for this does include a column for tax reimbursements. So if you're in the kind of outlier situation where you've got a tax gross up payment, well, you have to disclose that in a special column in the table. In practice, of course, in the more modern post say on pay environment, you rarely see that, and typically the compensation arrangements are going to deal with the potential of golden parachute excise taxes under 280G of the tax code in a different fashion. It might be, an automatic cutback where benefits are going to be reduced so that you don't trigger these excise taxes. Or it might be somewhat more common. It's a best after tax benefit sort of calculation. Executives will either receive their full benefits and pay the excise tax, or they'll have their benefits cut back, whichever, to avoid the excise tax, whichever produces the best after-tax benefit. So when that's your scenario, I mean, obviously there's a lot of assumptions and details that go into those calculations that are separate from the disclosure, right? About for tax purposes, are you going to have to reduce someone's benefit by how much? When it comes to disclosing in the table, I think the best approach really is just to disclose the full amount. If that's your scenario, if you've got a best after tax benefits provision or a cutback provision, disclose in the golden parachute table the full amount, ignoring the possibility of a cutback, right? Then you're telling people what the benefits that would be payable in connection with the transaction. And then in the footnotes, you can come in and explain, we've disclosed here, the full amount of the benefits to which these individuals are entitled, but under their arrangements with the company, those benefits might be reduced in order to avoid an excise tax that might otherwise be imposed on them under the tax code.
So you just mentioned the footnotes. Are there any lessons learned, practice tips about when it comes to dealing with these disclosures?
Yeah, I think the footnotes are something really to pay attention to when you're working on one of these golden parachute tables. Again, the table has a prescribed format, right? You've got columns for cash, equity, pension benefits and non-qualified deferred compensation payments, perquisites, other compensation, and a total, column. That's what goes into the table. And the table also tells you some footnotes that you need to include. One of those is, for any one of those columns, if you've got multiple sources of compensation, you need to break out in a footnote what those sources are. So, for example, if your cash column includes both, basic cash severance and a prorated annual bonus for the year that the deal occurs or termination occurs, well, you need to break that out in a footnote. Now, that's not surprising. That would be kind of expected. But another example of a required footnote is for each of the columns in the table, the rules tell you that you're supposed to include a footnote that quantifies how much of the amounts reported in each of those columns is attributable to a single trigger arrangement and how much is attributable to a double trigger arrangement. Not necessarily a footnote you would be expecting to see. And double trigger meaning for this purpose, a payment that is related to a change of control, but it's only triggered by termination without cause or for good reason within a particular period related to the change of control. So the table tells you need to break out the columns, all the columns. What's the part that's attributable to single trigger? What's the portion that's attributable to double trigger? And what's the double trigger termination period? Again, not a typical footnote that you might necessarily be expecting to include, but you want to make sure you include it. These deal disclosures are going to be reviewed. You're going to be filing a preliminary proxy statement with the SEC. Save yourself a comment from the staff by making sure you include these footnotes the first time around.
Great stuff, Nathan. So compared to the other tables that are in the annual proxy, where would you put this table in terms of being one of your favorites or not?
Well, I love it. I think it's a great one. Maybe it's the novelty. It doesn't show up every year, so it's fun to have a table that's a little bit different. We all know how the summary comp table works. They're all great. They're all great. They're all great tables.
Thank you very much. Awesome.
Thank you, Brock.